Simple, fast steps. Step number one, we're going to go over the plumbing and how this all works, and then we're going to dive into what Zoltan's specific arguments are. There are three main markets we need to understand: the repo market, the bond market, and the FX swap market. The repo market is basically a pawn shop for the financial system. They're financial institutions, call it Fannie and Freddie, a money market fund, hedge fund, or other banks, and they need liquidity. They need some cash overnight or for a specific time frame, but all they have is collateral, usually treasuries. So they'll go into the repo market and say, hey guys, we need some money overnight. And a lot of times it's these primary dealers. These are the big banks under the Fed's umbrella, such as Goldman Sachs, Citi, JP Morgan. They have their reserves and excess reserves held with the Fed. So if they've got some excess reserves, they'll say, okay, well, Mr. Financial Institution, we'll go ahead and give you that money overnight or for however long you need it. Maybe it's a 14-day term loan or a 30-day term loan. And then the financial institution will give the primary dealer collateral, which is that treasury. And then at the end of the repo, at the end of that term, they'll go ahead and swap. The financial institution will get the treasury back, and they'll give them the money that they borrowed with a little bit extra, so the primary dealer has a profit. That's what incentivizes them to lend into the repo market in the first place. Next, we've got the bond market. That's where treasuries are traded back and forth. Then it's the FX swaps market, which sounds fancy, but it's really quite easy. We've got Corporation A, which is American Corp. Corporation I, Italian Corp. Italian Corp needs to borrow some money in dollars. American Corp needs to borrow some money in euros. But if they do that, they're going to get charged a pretty high interest rate. So let's say both of them need the equivalent of right around $50 million. Italian Corp would borrow that money in euros. American Corp would borrow that money in dollars, a lot of times from the primary dealer banks. And then they would just go ahead and swap. It gives them a hedge so they have less currency risk and they get it at a lower interest rate. Now that we understand the basics, let's go directly to Zoltan's article and understand the details of his arguments. This is where it gets really interesting. The Fed's liquidity operations, in other words, repo madness, have not been sufficient to relax the constraints banks will face in the upcoming year-end turn. That's just the end of the year. Reserves are still insufficient. There are no true, quote-unquote, excess reserves. The large U.S. banks' G-SIB scores, and we'll go over that in a moment, are shaping up to be a severe binding constraint heading into the year-end turn. We have never had a year-end without a comfortable buffer of excess reserves, or when G-SIB scores could force most U.S. banks to turn off market making. What Zoltan is saying specifically is that at the end of the calendar year, there are always constraints on liquidity, meaning a lot more demands for cash. Editor, let's pull up the chart of the repo rate going back to last year at this time, and you'll see there's a noticeable spike. Usually there are plenty of excess reserves to handle that, but this year Zoltan thinks there are no excess reserves to act as a buffer. He comes to this conclusion for a few different reasons. Number one, because the government has been doing so much deficit spending, that creates additional supply of bonds. The primary dealers are the market makers, so they are required to buy those additional bonds. The Fed is also doing quantitative tightening, or QT. That's where they're taking the treasuries from their balance sheet and selling them into the market as well, generally to these primary dealers. So where do the primary dealers get the money to buy all of these treasuries that are raining down on them that they're required to purchase? from their reserves that they have with the Fed. That's why Zoltan thinks that the excess reserves are so limited. To make matters even worse, he talks about the GSIB, which is the Regulation Global Systemically Important Banks. The regulators come in and give the banks a score. Based on that score, they have specific capital requirements that they must meet. So at the same time where they're depleting their reserves, the regulators are requiring them to have more reserves. Zoltan thinks this is why the Fed has come in and done repo madness. That's where they inject the money into the repo market because the interest rates spike because there's not enough liquidity or there's not enough cash to satisfy that demand. Usually these primary dealers provide a lot of that liquidity to the repo market, and because they're getting squeezed over here, that's why Zoltan thinks that these primary dealers aren't going to be there to provide the liquidity at the end of the year. Next, Zoltan says the FX swap market shows implied yields that don't imply a bad year-end turn. Yet, it is the market most exposed to liquidity and balance sheet constraints. What Zoltan is saying there is the FX swap market is the most sensitive to the lack of cash in the repo market or the primary dealers not having enough cash on their balance sheet. So let's say the end of the year interest rates in this market are 6%. Zoltan says that's typical, that's normal. And if this market really understood what was going on with his explanation, those interest rates would be at 10%. In other words, they'd be a lot higher than the 6% that they're showing. Zoltan is saying that this means that nobody in this ecosystem understands the problems that he thinks he sees so clearly. The apparent lack of concern may come from last year's benign experience and that repo rates have been trading normally since the September blowout. And that's when the Fed started repo madness. But these facts are less relevant than they seem. Last December, U.S. banks had plenty of excess reserves and had no GSIB constraints. And that liquidity operations have kept a lid on repo rates since September doesn't mean they will be effective as balance sheets bind going into year end. So Zoltan thinks that because the Fed came in with repo madness and calmed the market down, and because last year we went through this cash squeeze where we had a liquidity bottleneck and nothing happened, the market thinks that everything is A-okay and they're just whistling right by the graveyard. The FX swap market becoming unglued is the biggest risk for RV hedge funds, relative value hedge funds' assumption that they will have balance sheet to fund their bond basis trades around the year-end turn and not to punitive rates, if at all. They've lined up forward settling sponsored repo trades to lock up balance sheet for the turn. But they don't know the rates they'll have to pay on these trades or if banks will be able to fund these trades. And they are missing the incentives at play. All right, if you're asking yourself right now, what the f did that guy just say? I'm going to explain it to you right now. Don't worry about it. All he's saying is at the end of the year, the hedge funds have this big gamble that they want to pull off. And to do that, they've got to go into the FX swap market. Right now, they're prepared to pay 6%, but if the interest rates go up to 10%, they're going to have to pay more for those bets. Where's that money going to come from? One of two places. Either their balance sheet, got a little balance sheet right here with assets and liabilities. They're going to have to draw down more cash, or they're going to have to go to the primary dealer and borrow it from them. The problem is that right now, like we said earlier, the primary dealer doesn't have any excess reserves to lend. Zoltan goes on to say, dealers selling forward settling sponsored repos over the turn have an incentive to introduce an imbalance in collateral markets to maximize the value of whatever excess reserves their bank operating subsidiary has left to lend over the turn. Whew! He is really trying to sound smart right here, isn't he, guys? In turn, the dealers' hedge funds expect to stand between them and the Fed to bridge the above imbalance may not be there for them if the FX swap market becomes unglued and offers better yields than the GC repos or general collateral repos. In other words, if the interest rates in the FX swap market go up to 10%, anyone with liquidity in this ecosystem is going to look at that juicy 10% and then look at this measly 2% in the repo market and say, hell no, I'm going right to that FX swap market and I'm going to get me some of this 10%. Believe it or not, that's literally what Zoltan just said. If we are right about the funding stresses, the Fed will be doing QE4 by year end. The safest asset, US Treasuries, is funded by RV hedge funds on the margin, and the FX swap market pulls balance sheet and funding away from them. The safest assets will go on sale. Treasury yields can spike into year end, and the Fed will have to shift from buying bills to buying what's on sale, coupons. And this is where his esoteric jargon really comes to a crescendo. And now this gets really complex, guys. So I hope you're sitting down. I really need you to concentrate. Follow me on this one. What Zoltan is saying is there's going to be a lot of treasuries for sale and no buyers. So the Federal Reserve is going to have to come in and buy those treasuries. In other words, QE4. I think Zoltan needs to hire my 5th grade nephew to write his next report. Step number 2, Zoltan Pozsar versus Jeff Snyder. When Zoltan came out with this report, Jeff went on the Macro Voices podcast because he had some major issues with what Zoltan was saying. So this gives you a completely different angle on this whole repo market situation. Snyder had 4 main disagreements. First and foremost, over the last few years, Zoltan has said that these dealers need to hold the treasuries. So just as a reminder, the primary dealer banks, they have to buy those treasuries from the federal government. They are the market maker. But Zoltan was saying that they need to hold them, which creates a liquidity restriction or less cash in the system. Snyder says that's flat out not true, because although they have to buy them, they can sell them just as soon as they buy them. And they're actually incentivized to do so because they can flip those T-bills, make a quick profit, take that liquidity, inject it right back into the repo market and make the spread. So there's no need for them to hold these on their books. Zoltan now has changed his tune, which disappoints Jeff Snyder quite a bit. You can tell how frustrated he gets in the interview. And he's now saying that, yeah, they can go ahead and sell those treasuries. They don't have to keep them on their books, but they're choosing to keep them on their books now because they're trying to front run QE4. Well, what does that mean? What Zoltan's saying is that these banks know that the Fed is at some point in time going to have to come in and start buying long-term treasuries again. It's just a foregone conclusion. The banks know that if the Fed comes into the bond market, that's going to create artificial demand for those treasuries. Well, if there's more demand for those treasuries, that means the price of the treasuries will go up. So the banks are holding these treasuries because they think the Fed's going to come in and increase the price. That's what front running is. Snyder's second argument is that the front running just isn't possible because it would be a really stupid thing to do. Why does he say that it's stupid? Because if you look at a chart of QE, editor, go ahead and pull that up right now, and you layer over another chart of the treasury prices, And keep in mind, there's an inverse relationship between the Treasury prices and the interest rates or the yield. So when the yield goes down, the prices go up. If what Zoltan was saying were true, you'd expect to see a correlation between the amount of quantitative easing done and the interest rates of treasuries, like the 10-year, going down. Because you don't see that, Jeff is saying that can't be a legitimate reason for why the banks are holding on to treasuries. Snyder's third disagreement is every point that Zoltan is making is completely predictable. Whether it's the GSIB, taxes, quantitative tightening, increased deficit spending by the government, none of this has come out of the blue. Since it's predictable, why hasn't the Fed taken the measures necessary to plug those holes in the market? The bottom line, and this is disagreement number 4, is that there isn't a calendar risk. So Zoltan is saying that all these things that happen at the end of the year creates this risk. It's a date and time. Snyder is saying that is nonsense. It's not calendar risk that we should worry about. It is systemic risk, meaning that these banks are holding on to treasuries not because they're trying to front run the market, but they're holding on to treasuries because there's systemic risks in the banking system that they can see and we cannot see. Step number 3. Do I agree with Zoltan Pozsar or Jeff Snyder? Actually, I agree with them both, but for different reasons. Let me explain. I do think we'll see QE4 very soon. I don't know if it'll happen at the beginning of the year, but I think at least into 2020, we'll be seeing what the Fed defines as QE4, not what they're doing right now in the repo market, which every other sane human being on the planet Earth would define as QE4. And the difference between those two things is that right now, the Fed is buying short-term T-bills, and technically, by their definition, they'd have to buy long-term treasuries in order for it to be considered QE. I also agree with Jeff Snyder that there's systemic risks in the system, and that's why the primary dealers are holding on to those treasuries. They look at Deutsche Bank, Santander, HSBC, and say, no way are we lending them money overnight or for a 14-day term, 48-day term, whatever it is. Going back to Zoltan, I think the banks could be front-running the market, but I don't think they're front-running the Fed. I think that because of this systemic risk that they see that Snyder is talking about, they could be front-running a crisis. Why would they do that? Because the safe haven asset, as the world sees it, right or wrong, right now, are U.S. treasuries. So if they see a crisis coming in the future as a result of this systemic risk that they can see and no one else can, they're going to hold those treasuries, because when that crisis happens, the price of these treasuries will go through the roof. For more information like this, check out this content right here, and I will see you on the next video.